Hello, everybody. Welcome to my Intermediate Accounting 17th edition video solution walkthrough for case analyses for 2.5 and 2.6. This is coming from the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingan, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. So we're kind of entering into theory land. And when we're entering into theory land, I'm not really looking at the solutions to the Kiso textbook. Rather, what I'm giving you are my opinions, like kind of on a spontaneous basis as I'm looking through these different items. And what could be happening is that if I were to look at them more and more, I may melt, but what also may happen is I might have other takes on what we're going through and doing. So as we look over here in terms of like the various different parts, you've got economic, these are the different kind of the fundamental qualities of accounting. As I've said in previous videos, I strongly recommend that you go through and you memorize this. If you're a student in my intermediate accounting class, I'm going to make you memorize it. I'm going to make you write it out on your test. So if I'm having you do that, you can kind of get a pretty good idea in terms of the importance of it. I generally don't do that unless it's something that's important. Okay. Case analysis 2.5. I just want to make sure I'm calling this right because I think it's, concepts for analysis. There you go. Concepts for analysis, CA. There you go. Okay, call it California or BK. All right. So after the presentation of your report on the examination of the financial statements of the board of directors of Piper Publishing, one of the new directors expresses surprise that the income statement assumes that an equal proportion of the revenue is recognized with the publication of every issue of the company's magazine. She feels that the crucial event of the processes of earning revenue in the magazine is as a cash sale of subscription. Okay. She says she does not understand why most of the revenue cannot be recognized in the period of the cash sale. So this is why you have a designated financial expert on the audit committee of the companies, because if you have a director that feels this way, they probably, hopefully they're not on the audit committee. If there are, it might be a problem, especially if they're the designated financial expert. Who is on a board? The shareholders of the corporation elect as their representatives the board members. The board members have two primary responsibilities. It's hiring the CEO and the CFO. There might be other positions that are higher, but those are the two primary responsibilities, as well as approving various different transactions, right? So right over here, the timing in terms of the revenue recognition, right? So when you get cash, when we recognize revenue. So when we get to chapter 18, we're going to learn a lot more about the revenue recognition principle, which is what's the basically like what's the contract, what's the identification of the contract, what are the performance obligations, what's the consideration, how do we tie the consideration, the performance obligations, and then we recognize the revenue. But here I've received money and I have not gone through and recognize the revenue. So the timing of revenue recognition again, and when will you actually be meeting board members? Well, in terms of the SEC rules, the auditors are required to have a meeting with the audit committee of the board of directors. The audit committee has to just be consisting of the independent directors only. They can invite other members in, but the audit committee is supposed to be with the independent directors only. So you've reported on the financial statements to the board of directors. And during that presentation, they don't know that. I mean, if you ask this as a board member, I mean, it wouldn't be a good thing. So here you go. So discuss the proprietary of the timing of the revenue recognition with accounts. So we're not a cash basis company, we're an accrual basis company. So you would never use the cash basis. And why? Because I haven't earned it until I've shipped out the magazines. That's why we debit cash, credit unearned revenue. It's unearned because I haven't done it. Now, the publication of the magazine every month, that makes a lot of sense. And, if the magazine, once it's been shipped, that's probably when you can kind of go through and do it. So the publication, you're going to recognize the fractional revenue related to that subscription. Over time, as the magazines are published and delivered to customers. Now, if you're going through, I would probably say you're going to recognize it when they're shipping, but I don't know what they mean by over time. I would say if you're publishing it and delivering every month, to me, B and C sound very familiar. So again, but we would want to be very nice to the board member because they hire and fire us as auditors. But at the same time, you've got to deliver the information that they need to know. And yeah, scary. Okay. An accountant, let's go to conceptual. Did I say that right? Is it concepts for analysis 2.6? Okay, by the way, the book for this that I'm using is free on zlibrary.org. So go check that out. Okay. An accountant must be familiar with the concepts involved in determining earnings of a business entity. The amount of earnings reported for a business entity is dependent upon the proper recognition in general of revenues and expenses for a given time period. In some situations, costs are recognized as expenses at the time of the product sale. In other situations, guidelines have been developed for recognizing costs as expenses or losses by other criteria. Okay, so explain the rationale for recognizing costs as expenses at the time of the sales. Well, we have something over here called the matching principle, and which I guess is that actually now gone? Well, we're going to recognize our expenses. We're going to want to try to match them against the revenues wherever possible. So if I'm making a sale, that's when I want to go through and recognize the related expense. So again, basically, I'm going to try to match my expenses with my revenues wherever possible, but that's really kind of what's behind going through recognizing costs as expenses at the time of the product sale. That's when I want to go through and recognize it, because if I've been, if I have this inventory sitting around, and that's when I'm going to basically book it to cost of goods sold when I make it at the time of the product sale. Because if I've done substantially everything that I need to do to complete the sale, then that's when I want to recognize the expenses against that. Okay. Now, what's a rationale underlying the appropriateness of treating costs as expenses of a period instead of assigning the cost to an asset? Explain. Well, what does that really mean? Well, treating costs as expenses of a period of assigning instead of assigning the cost to it. Okay. So this is basically if I'm going through and I'm selling something that I own, it's not something that I'm going to be going through and putting in as an asset. Now, if I have costs and I'm a manufacturer, if you took managerial accounting, which I hope you did, in that particular case, I'm basically going to be accumulating costs into the WIP. Then it's going to go to finished goods inventory. In that case, I'm accumulating the cost of the asset, but then I have to go through and then basically expense it when I sell it. But cost is expenses of a period. So if I'm using something during a period of time and it doesn't have any residual economic benefit, then I'm going to go through and expense it. I think that's what that means. In general, in what general circumstances would it be appropriate to treat a cost as an asset instead of as an expense? Well, if I have a cost, like, so for example, if I'm a manufacturer and I have work in process, raw materials, those types of costs are going to be, those should be an asset until I go through and sell it. So in that case, it would be, the cost would be an asset. If I'm self-constructing an asset, right, property, plant, and equipment, that's going to go into construction and process. So that's what that is. Okay, some expenses are assigned to specific accounting periods on the basis of systematic and rational allocation of asset cost. Explain for the rationale for recognizing expenses on a basis of systematic and rational allocation of asset cost. I'm assuming that this is talking about something like depreciation expense, where I'm basically assigning, that's a systematic and rational allocation. So if I have depreciation expense, I'm assigning this based as I'm using the asset. So if I purchase property, plant, and equipment, I don't want to expense it all at once because it's giving me multiple periods of economic benefit. So therefore, the better thing for me to go through and to do is to go through and to basically expense it over a period of time. Okay, so identify the conditions under which it would be appropriate to treat a cost as a loss. Okay, so great example is that if I build inventory, right? So I've got the inventory and I do a lower of cost or market analysis, right? And if it determines that the amount that I've gone through and if the asset or if it has been impaired, the inventory value has been impaired, then I would show that as a loss due to inventory obsolescence. So the conditions under which it would be appropriate to treat a cost as a loss is that if I have something sitting on my books and then that asset really has no value, so I have to either impair the asset or have to write it down to what the asset's value truly is. So that would be an example of a condition of where I would have to treat a cost as a loss if for some reason I have something on my books, but it no longer has like that value. So that is concepts for analysis 2.5 and 2.6. I hope you've enjoyed these videos as much as I have. Again, I want to give a big shout out to Wiley for allowing me to use their materials. Don't forget to like and subscribe. And if you want to see another solution, feel free to send me $3 million. I'm just kidding. Just feel free to send me a message on the comments on YouTube and I will do my best to get back to you. Have a great one. We'll talk soon. Take care.